You hear about GDP and inflation on the news all the time, right? But what do those terms actually mean for your wallet? Well, over the next few minutes, we're going to connect all the dots. We'll start with something as simple as trading chickens for stuff and take it all the way to understanding the huge forces that shape our entire economy and your own personal finances.
All right, so here's our game plan. We're going to start at the very beginning with simple trades, and then we'll uncover the basic rules of money. From there, we'll look at how economists basically give the whole economy a grade. We'll dive into the ups and downs, and finally, we'll bring all these big ideas right back to you in your own life.
So let's rewind the clock. I mean, way, way back. Before there were coins or cash or credit cards, people still needed things. So how did they get them? The answer was trade. But believe me, it came with a massive headache.
Just try to imagine this for a second. Let's say you need a new phone, but all you have to trade are chickens. First, you'd have to find somebody who's actually willing to give up their phone. Then, that exact same person would also have to be in the market for some chickens. And even then, you'd have to agree on how many chickens a new phone is worth. It's a total mess, right? And that was the huge glaring flaw in the barter system. And this is exactly why money became one of the most important inventions in human history. Seriously, it was a game changer. It solved three huge problems all at once. First, it acted as a medium of exchange. Everyone agreed to accept it, so you no longer had to find that one person who wanted your chickens. Second, it created a unit of account, which means everything has a standard price. No more arguing over the chicken-to-phone exchange rate. And finally, it serves as a store of value. You can save money for later, which, let's be honest, is a lot easier than trying to save a bunch of chickens. Okay, so money solved the barter problem. Fantastic. But that just opens up an even bigger question. What gives a piece of paper, or just a number on a screen, any value at all? To get that, we have to understand the basic rules of money.
You know, at its core, money works because of one thing. We all believe it does. It's not valuable because the paper is special. It's valuable because we've all collectively agreed that it's valuable. It's what's known as fiat money. From ancient shells to gold coins to the digital numbers in your bank account, it all works because we share a trust in the system.
So what decides the price of, well, anything? It all comes down to two simple forces, supply and demand. Think about a pair of super limited edition sneakers. A ton of people want them, that's high demand, but there are very few pairs to go around, that's low supply. So what happens? The price skyrockets. Now let's flip it. Think about those fidget spinners from a few years ago. They are everywhere, high supply, but pretty much nobody wants one anymore. Low demand. The price? It tanks. This little dance sets the price for nearly everything.
Okay, now this is where things get a little bit wild. Most of the money out there isn't actually printed by the government. It's created by commercial banks. So here's how it works. You deposit $100 into your bank account. The bank is required to keep a small fraction of that, the reserve, but it lends out the rest, let's say $90. Now the person who borrowed that $90 spends it, and the person who gets it deposits it into their bank. Now that second bank keeps $9 and lends out $81. This whole process, which is called fractional reserve banking, is literally creating new money in the financial system, all from that original deposit.
This leads to a really critical balancing act. If a central bank just starts creating way too much money way too fast, you suddenly have a flood of dollars chasing the exact same amount of stuff to buy. And what happens then? Well, sellers realize people have more to spend, so they raise their prices. All of a sudden, your dollar just doesn't stretch as far as it used to. Its purchasing power has gone down. And that phenomenon, that's inflation.
So we've seen how individual dollars can lose their value. But how do we measure the economic health of an entire country? Well, economists use one key number as a sort of national report card. It's called GDP. GDP stands for Gross Domestic Product, and it is a massive number. It's trying to add up the total value of all the final goods and services produced inside a country's borders in one year. Everything from the cost of your haircut to the price of a newly built car, it all gets tallied up to give us a snapshot of the size of the economy.
So what does this one giant number actually tell us? It's pretty straightforward. When you hear that GDP is rising, it means the whole economic pie is getting bigger. Businesses are growing, more jobs are usually being created, and things are humming along. But when GDP falls, that's a warning sign. It means the economy is shrinking, and if that keeps happening, it could signal a recession.
We've mentioned these two big terms a couple of times now, inflation and recession. They represent the major highs and lows that every economy goes through, so let's put them under the microscope and see what they're really all about.
Okay, let's break these two down. Inflation simply means your cost of living is going up. Prices are rising and your money buys less tomorrow than it does today. Now, what's kind of weird is that most economists actually think a little bit of inflation, maybe around 2%, is a good thing. It encourages people to spend and invest. A recession, though, is the opposite problem. It's a major economic slowdown, officially defined as at least 6 months of a shrinking GDP. But for regular people, it usually means job losses and a whole lot less spending. So we've been talking about the whole economy, trillions of dollars, millions of people. But how do these massive forces of inflation and GDP growth actually affect you? Well, it all comes down to your personal balance sheet. It's actually really simple when you think about it. On one side, you have your assets. These are all the things you own that have value, like cash, a house, investments, maybe your car. On the other side, you have your liabilities. This is everything you owe, like student loans, credit card debt, or car payment.
And here it is. This is the single most important rule of personal finance, and it is beautifully simple. A healthy financial situation is when your assets are greater than your liabilities. That positive difference between what you own and what you owe, that's your net worth. The bigger it gets, the more financially secure you are. It's that simple.
So when you zoom out, you see the economy isn't just some machine humming along in the background. It's more like a living, breathing ecosystem. Every time you buy a coffee, you're a part of it. Every time a business hires someone, they're shaping it. And every time a government adjusts its policies, they're trying to steer it. Your choices, multiplied by millions, are what create the big trends we call GDP and inflation.
So, you see, this isn't just about wealth, it's about learning a language. Terms like GDP, inflation, assets, they're the vocabulary. And once you understand them, you can read the news, make smarter decisions with your own money, and really feel more in control of your financial future.
We've gone all the way from trading chickens to the engine of the global economy. You now have the basic toolkit to understand how it all works. So the next time you hear about inflation going up or GDP falling, you'll know it's not just a headline, it's a signal. The real question is, how are you going to use that signal to play the game?